America is busy waging tariff wars, while Canada quietly takes over the game. While Washington struggles through trade battles and promises of manufacturing revival, Ottawa has already built an entire new empire. From electric vehicle batteries and rare minerals to a global trade network. No need for a slogan like "Make Canada Great Again," they just got it done. And now, the question is no longer can Canada catch up with the U.S., but can the U.S. catch up before it's too late? The quiet neighbor has awakened. No alarm bells, no breaking news, and certainly no declaration of a power shift. But looking back at 2025, economists, businesses, and trade strategists will unanimously agree. Canada is no longer the economic shadow to America's north. The country once labeled calm and polite is quietly rising, not through military might or confrontational policy, but with a weapon that once seemed old-fashioned and now returns with force: supply chain strategy. For decades, the U.S. was the center. Every transport route, every assembly plant, every industrial ecosystem in North America revolved around the giant gear known as the Washington Consensus. But since the COVID-19 pandemic, followed by geopolitical shocks and multiple terms of America First policies, that system began to crack, and Canada was the first not only to see those cracks, but to know how to slip through them. Ironically, this rise wasn't marked by a glowing report from the Bank of Canada or a sudden GDP spike. It began with choices that were almost defensive. When the U.S. raised tariffs, Canada didn't retaliate. When the U.S. tightened investment rules, Canada relaxed them. When the U.S. prioritized slogans, Canada focused on infrastructure. That very quietness became the foundation for a major turning point. What happened behind the scenes is what's rewriting the balance of trade power in North America. While U.S. officials spoke about reindustrialization, CEOs from Europe and Asia were secretly choosing Montreal over Detroit, Vancouver over Los Angeles. They didn't choose Canada because it was cheaper, but because of something far more valuable in a post-pandemic world: stability. What U.S. policymakers underestimated and are now paying the price for is Canada's endurance and hands-on approach in rebuilding supply chains. They didn't build flashy mega-factories. They invested in every link, from seaports and smart warehouse networks to business-friendly tax systems to efficient logistics that connect domestic and global flows. They didn't need media campaigns to attract capital. The capital came on its own. If you want a clearer picture, look at the non-political indicators. In the first half of 2025, container volume at Prince Rupert Port rose over 22% year-on-year, while America's Long Beach port fell nearly 9%. This isn't just about numbers. It's a shift in trust. Every ship, every container chooses a destination not just because of geography, but because of faith in execution, in a system that doesn't shake with every election. Canada's awakening is not a rebellion, but a maturation. They're not competing on the same stage as the U.S. They're building a new one, where they are the director, the lead actor, and most importantly, the scriptwriter. That may unsettle or even offend some Americans. But from the view of global investors, it's the logical choice. Perhaps it's time for Washington to relearn what it once taught the world. Economic power doesn't lie in the louder voice, but in whoever controls the flow of goods and the flow of trust. Canada, once seen as the less dynamic neighbor, is now reteaching that lesson through silence that works. The underground weapon. There's something Washington doesn't want to admit, but American EV manufacturers, defense companies, and tech giants know it all too well. Canada is holding the most dangerous strategic weapon in today's global trade race. Not nuclear bombs, not hypersonic missiles, but cobalt, nickel, lithium, silent elements buried underground that are reshaping the entire geopolitical balance. In an era where technology and clean energy are the twin pillars of power, whoever controls rare mineral resources controls the future. And that's the exact game Canada is playing. Wisely, persistently, and without theatrics. From the snowy fields of Yukon to the industrial belt of Sudbury, from mines in Labrador to seaports in Quebec, this country is turning mining sites into strategic energy gateways for the 21st century. The interesting thing is, Canada hasn't exactly just emerged. It's been among the world's top 5 nickel producers for over a decade. But what's changed in the past 5 years, especially since 2023, is its role, from raw material supplier to strategic coordinator. No longer just digging and selling, Canada is now heavily investing in refining, transportation, and more importantly, controlling the starting point of the high-tech supply chain. This has become especially relevant as the U.S., for security and strategic reasons, has bound itself to sourcing minerals from friendly countries to qualify for benefits under the Inflation Reduction Act. And so, all roads lead to Ottawa. When President Trump signed off on higher tariffs for Chinese and European goods, he probably didn't expect that move to make American corporations even more dependent on northern supply. While the U.S. government declares its goal of domestic manufacturing independence, reality tells another story. Even if you want to build batteries at home, you still need cobalt from Ontario, nickel from Quebec, and rare earths from Labrador to make it happen. This isn't just a geological story. It's a story of power. In today's world, countries don't need guns to control one another. They only need to possess what the other can't live without. And strategic minerals are becoming an unspoken tool for negotiation, pressure, and shaping bilateral relations. What Canada is doing, and doing very effectively, is creating intentional choke points. They're not declaring their resources a weapon, but they're certainly not offering them cheaply, easily, or without oversight anymore. In 2024, the Canadian government committed 10 million Canadian dollars to develop roads and port infrastructure specifically for rare earth exports in northern Labrador. A figure that may seem small in national budget terms, but is a strategic bet on Canada's role as a nerve center in the high-tech supply chain. A single road, a port, a refining plant. But behind all that lies the power to say we can open, sell, or close the tap at any time. Step by step, Canada is no longer just a raw resource mine for superpowers. It's transforming into a resource coordinator with modern refining systems, international logistics capabilities, and, most importantly, negotiation leverage rooted in the very assets the world is desperate for. While America is busy rewriting tax laws and rebuilding factories, it may have already fallen a step behind in this strategic race. Because when you think only of manufacturing but forget where the materials come from, you're building a house on land someone else owns. Canada has quietly claimed that land. And now, not just America, but the world is beginning to ask for permission. Electric batteries and the new power map. It's no coincidence that the 20th century was called the Age of Oil, but the 21st century, the era of climate crisis and energy transition, is being led by something quieter, smaller, but far more powerful: the battery. Behind every electric vehicle is a battery. Behind that battery are a range of raw materials: lithium, cobalt, nickel, and behind those materials is Canada. If in the previous section, Canada was described as the keeper of the mineral key, then on the next level, this country is transforming into the electric battery production hub of the entire North American continent. Not with fanfare, not with slogans, not with noise. Just targeted investment decisions, massive financial commitments announced without trumpets, and factories rising from the ground as if someone had planned it long ago. Windsor, a name once tied to the Ontario-Detroit border, is now being mentioned in a completely different light. It's no longer the quiet suburb next to America's manufacturing corridor. In 2023, the federal government and Ontario province jointly poured in up to 15 billion Canadian dollars to turn this place into the heart of the electric battery industry, with a massive project led by the Stellantis and LG Energy Solution joint venture. Less than a year later, Volkswagen announced the construction of a similar battery plant in St. Thomas, and Canada took another step forward. This isn't just a race of output. This is a race of value chains. Gone are the days of extract, sell, re-import. Canada is building a closed-loop ecosystem: extraction, refining, material production, battery assembly, and finally direct supply to EV manufacturers, most of whom are located within its own territory. That's the part the U.S. is still struggling to complete. Because to build a closed chain, you need not only capital, but stability, long-term planning, institutional trust, and time. Things that Canada somehow already has. In Bonor, Quebec, Ultium Cam, a joint venture between General Motors and POSCO Future M, is constructing a cathode material plant, one of the key components in EV battery structure. The Quebec government isn't waiting for investors to fend for themselves, but is providing a 150 million Canadian dollar loan to ensure progress. In the same area, another plant, focused on copper foil production, an essential material for EV batteries, is also receiving similar financial support. So, what allows Canada to do what even the U.S. hasn't been able to complete? The answer lies in a dual-level cooperation strategy. On one hand, Canada stands firm on its own policies, with clear domestic frameworks and long-term commitments. On the other hand, it leverages American policies, like the Inflation Reduction Act, IRA, to position itself as an indispensable partner. Because under IRA rules, for EVs to qualify for tax credits of up to $7,500, battery components must be made in North America, and raw materials must not come from unfriendly nations. No argument needed, no loud declarations. Canada simply makes itself the most agreeable option. As American politics become increasingly unpredictable, with re-election waves, partisan divides, and Washington's volatility, investors need a place where policy doesn't change with every election cycle. And Canada, with its characteristic consistency, has become the safest choice amid uncertainty. This shift isn't just strategic, it's symbolic. If in the previous century people looked to Detroit to imagine the future of the auto industry, then in this century their eyes are shifting north, where batteries are quietly redrawing the power map of the world's biggest industry. No gunfire, no financial crisis triggered this turning point. Only carefully prepared decisions, precisely aimed investments, and a nation that chose the right moment to lift its head high. Today, Canada is no longer just a supplier of raw materials, but is becoming the very origin of a green revolution, with batteries and with strategy. When America relies on an escape route called Canada. It's deeply ironic that while the United States is busy guarding its trade borders with thick tariff walls, it's American companies themselves that are quietly carving out an escape route. And that route leads straight to Canada. In the spring of 2025, Costco CEO Ron Vacris made a short but supply chain-shaking statement. We will produce Kirkland products where we sell them, and Canada is our #1 priority. The reason needed no long explanation. U.S. tariffs are too unstable. Meanwhile, operating costs in Canada are so steady that policymakers in Texas or Georgia can't help but look north with both envy and caution. On one hand, Washington continues to push domestic manufacturing policies. On the other, American corporations are restructuring supply chains, shifting numerous production stages to Canada to dodge U.S. policy. This isn't just a paradox, it's a sign that real policy impact doesn't lie in rhetoric, but in market behavior. And the market is speaking clearly. Canada is the place to avoid cost, risk, and hassle. This dependency doesn't stop at consumer goods. It has spread to critical industries. In August 2024, the Pentagon took a rare step, allocating $20 million to build a cobalt refining plant in Ontario under the Defense Production Act. This wasn't just a routine commercial investment. It was a signal that America's national security now partly lies in Canadian hands. The truth is, when it comes to key sectors like electric vehicles, military equipment, and semiconductors, the U.S. can't be self-sufficient, as many politicians have promised. To avoid tariffs, to access reliable resources, to have speed and certainty in production, they need Canada. And that's a reality not easily reversed. Moreover, the Canadian government has made it clear that it's not just a manufacturing gateway, but a partner with vision. While Washington struggles through tense negotiations with the EU, China, or ASEAN, Ottawa quietly lays the foundation for a parallel supply chain, a system where goods continue to flow no matter how chaotic the politics get. In January 2025, according to U.S. Department of Commerce data, 71% of potash, a key fertilizer component, was imported from Canada. 50% of refined zinc, 23% of nickel, along with a host of other industrial minerals, also came from the north. That means from farmers in Iowa to factory workers in Detroit. The U.S. economy, whether admitted or not, is tightly bound to Canada's resources and processing capabilities. And once bound comes leverage. Canada doesn't wave that leverage around like a stick. They don't threaten. They don't coerce. But they build it into the system, softly and precisely. Every factory receives funding support. Every logistics route is expanded. Every trade agreement isn't signed to declare sovereignty, but to ensure that anyone in need of reliable supply must knock on Canada's door. Meanwhile, deep contradictions are surfacing inside the U.S. The protectionist policies designed to protect American workers are now closing factories, rerouting orders, and pushing companies to flee. They can't wait for Washington to adjust. They need somewhere safe to survive. And once again, that place is Canada. What's notable is this shift isn't temporary. It's already embedded in corporate strategy, long-term contracts, factories under construction, hiring underway in Ontario, Quebec, Alberta. All of it shows this is not just a trend, it's a strategic direction. And just like that, Canada, once seen as the economic sidekick, is becoming the sanctuary for an entire U.S. ecosystem that's losing its bearings. No fanfare, no challenge. They just keep being who they are, stable, flexible, and welcoming. The question is no longer, why are U.S. companies moving to Canada? But rather, when will they dare to return? When Canada is no longer just a member of the agreement. There was a time when Canada was seen as the gentle gatekeeper of the USMCA, an economy invited to the table, but rarely leading the game. But times have changed, and 2025 is witnessing something few imagined just a few years ago. Canada is no longer just a member of trade agreements, but is becoming the strategic architect of a new global trade map. Multipolar, flexible, and not necessarily centered around the United States. This transformation didn't come from a dramatic turning point, but from a series of consistent, quiet, yet ambitious choices. While Washington got stuck in internal conflicts and endless renegotiations, Ottawa chose a different path. Not to keep staring at the old table, but to seek new ones. And in the world of international trade, new tables mean new agreements, new partners, and new spheres of influence. CPTPP, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, was abandoned by the Trump administration, but Canada didn't walk away. On the contrary, it seized the opportunity to reshape its role. From a supporting ally in NAFTA to one of the key nodes connecting trade across Asia-Pacific. And as the U.S. turned inward, Canada looked outward, signing free trade agreements with the EU, the UK, South Korea, and most recently, ASEAN. In total, by mid-2025, Canada had secured trade deals that offer direct access to over 1.5 billion consumers globally, covering nearly 66% of the world's GDP. These are not just talking numbers, they are proof of a long-term calculated strategy. While the U.S. continues to wrestle with interest groups and Buy American declarations, Canada has chosen to sell Canadian, not just selling goods, but selling stability, transparency, and global coordination capacity. The turning point came at the end of 2022, when Ottawa announced its $2.3 billion Canadian dollars Indo-Pacific strategy, a blueprint that extended beyond goods, encompassing infrastructure, logistics, diplomacy, and digital trade. Unlike a simple aid package, this strategy was Canada's way of buying a seat in the fastest-growing region on the planet, without needing force or coercion. What was the result? In just March 2025, Canada's exports outside of the U.S. surged nearly 25%, particularly to Asia and Europe. While the U.S. still struggled with tariff barriers, it built itself. And more importantly, that trend isn't reversing, because the deals are signed, the trade routes are mapped, and trust from global businesses has been established. In that context, the role of the USMCA, once the strategic center of North America, is gradually fading. Not because it's lost its value, but because Canada is no longer dependent on it. When Canada's economy can grow through alternative export channels, when Canadian businesses can access major markets without the U.S. As a middleman, Washington's influence must inevitably adjust. This poses a major challenge for the U.S. In a trade world that's becoming multipolar, can an inward-looking strategy still be effective? Or is it unintentionally handing leadership to partners once seen as supporting caste? From a country once regarded as a follower, Canada is stepping forward with a trade map it is drawing itself. No need for Washington's permission. No need for applause from superpowers. Just commitment, planning, and real contracts. While the world watches America's trade disputes like an endless TV drama, Canada is quietly launching new flight routes to Jakarta, negotiating a new port with Antwerp, and building a logistics hub in Incheon. They don't shout Canada first, but the world is starting to feel it. Canada is stepping to the front, not with force, but with strategy. Capital has chosen the North. In today's modern economy, the most reliable vote doesn't come from surveys or international forums. It comes from where the money flows. And when global capital begins pouring strongly to the North, when multinational corporations quietly choose Canada as their new production base, it's no longer just a choice. It's a statement. In 2023, while the U.S. remained a major investment hub, Canada quietly rose to sixth place globally in attracting foreign direct investment, FDI, with a total value exceeding $50.3 billion, up 9% from the previous year. But what matters isn't the growth figure itself, it's the nature of those investments. They didn't pour into real estate to hoard land, nor chase stock market bubbles, but focused on long-term pillars: logistics, clean energy, artificial intelligence, high-tech manufacturing, and strategic ports. While trade and fiscal policies in the U.S. are increasingly becoming political experiments, subject to change with every election cycle, Canada offers an ever rarer advantage: predictability. For global investors, that's not boring. It's an opportunity to plan long-term without waking up one Monday to a tweet that flips the market. A prime example is Centerport Canada, a mega logistics hub integrating rail, road, and air in Winnipeg. It's not just a modern industrial zone, but the new heart of the Trans-Pacific Midwest Trade Corridor. Goods from Asia land at the Port of Vancouver, travel cross-country by rail to Winnipeg, then are redistributed via highway or air directly to key states like Illinois, Ohio, or Texas. This isn't just a cost equation, it's a matter of strategic security. In a world where geopolitical risks can flare up at any time, from conflicts in the South China Sea to tensions at the Suez Canal, corporations need alternative transport routes and production zones less exposed to hotspots. And Canada, with its Pacific coastline, transcontinental links, and multipolar trade relationships, has become a rare anchor point. An even clearer example is the boom of storm-avoiding industrial projects. In the fourth quarter of 2024, Canada's exports to Europe and Asia rose by 11.4% and 14% respectively, while exports to the U.S. only inched up slightly. Those numbers are not outliers. They reflect a trend. Global manufacturers are diversifying their supply chains, and they're choosing Canada as a safe transit zone, where political obstacles are fewer, production is efficient, and goods can be sold with peace of mind. This sharply contrasts with the situation in the U.S. during the same period. Following new tariff rounds from the Trump administration, U.S. exporters were squeezed by retaliatory tariffs, more complex inspection systems, and skyrocketing input costs. Meanwhile, Canada took full advantage of its existing trade agreements to sidestep those bottlenecks and smiled before anyone realized they'd been outmaneuvered. Beyond trade strategy, Canada has skillfully aligned FDI with its tech transformation strategy. In 2024, most international investments into Canada weren't misdirected, but funneled directly into AI, robotics, and clean energy infrastructure. These are the sectors the world is hungry for. And Canada doesn't try to leap ahead with flashy breakthroughs. It moves deliberately, with a solid roadmap and dependable execution. Canada's GDP growth in Q1 2025 reached 2.2%, exceeding all market forecasts and leading the G7. But again, the key point isn't the number. It's the accumulating trust. The trust that this is a place worth betting on. The trust that money no longer needs to be protected by slogans, but by a system that keeps its promises. As the world starts to reassess the idea of a reliable manufacturing center, they may no longer look to places that once symbolized industry, but turn their gaze north. And when capital chooses Canada, it's not a coincidence. It's the final word in a debate America always thought it was winning. The truth has changed, and money, as always, spoke first. When power is rewritten through silence, the world is used to looking toward Washington for a signal, a new bill, a major announcement, a press conference between the White House and big business. For decades, the U.S. was not only the center of power, but also the scriptwriter for most of the global trade game. But in 2025, something strange has happened. That script is starting to be rewritten, not by the sound of gavels on Capitol Hill, but by the quiet hum of cranes operating in Ontario, Quebec, and Vancouver. Canada, the roommate in the North American apartment, has never been loud, but it's that very silence that has become a deadly advantage. While the U.S. is tangled in political fights over tariffs, protectionism, and trade renegotiations, Canada doesn't argue, doesn't complain, doesn't wait. They just do. And the more they do, the closer they move toward the role the world once automatically assigned to the U.S., the keeper of North American trade order. From the busy ports of British Columbia to the modern industrial zones of Nova Scotia, Canada is rebuilding a new kind of trade infrastructure, a transcontinental backbone connecting the Pacific to the Atlantic, not dependent on choke points called U.S. politics. No need to confront, Canada simply continues to be the place where goods move faster, cheaper, and with more certainty. In May 2025, Nutrien, Canada's agricultural giant, announced a massive transshipment port project on the Pacific coast, aimed at meeting rising demand from Asian markets. This wasn't a spontaneous move. This was a strategic puzzle piece placed right when shipping companies began recalculating routes after repeated disruptions from the U.S. and global hotspots. In that picture, the most important thing isn't any particular port or FDI figure. It's the new mindset. Canada is behaving like a leadership nation, without flags, without speeches, but with a level of strategic maturity the world is increasingly valuing. Markets don't react to promises. Markets react to measurable trust, in delivery speed, in the ability to honor commitments, in rules that don't change after every election. And, in this regard, Canada is ahead of the U.S. Not because the U.S. lacks capability, but because it has let itself get trapped in internal spirals, where every economic decision becomes a political weapon, and every step forward is restrained by fear of losing votes. So, when Trump or anyone in Washington plans a trade counter-strike, they're in fact striking against a battlefield where Canada has already built the fortress. Every new tariff, every trade barrier erected by the U.S. only pushes American businesses further north, where they find a more predictable, more deployable, more expandable ecosystem. And what about the rest of the world? They're beginning to choose Canada as the transit point into the U.S., or even bypass the U.S. altogether. Some European tech corporations have started placing regional offices in Toronto instead of Boston. Korean electronics firms are signing direct deals with Quebec to produce EV components without U.S. intermediaries. The more companies do this, the more a new trade model takes shape, where Canada is the point of origin, no longer a transfer station depending on the American economy like before. What are we witnessing? A regional order being turned on its head, not with noise, but with quiet efficiency. Canada doesn't need to win a war. It just needs to win without fighting, by making others choose them, rely on them, and eventually depend on them. And that is happening without any announcement. If the U.S. continues to be trapped in the cycle of protectionism and domestic politics, if its policymakers keep treating trade as a tool for winning voter points, then one day soon they'll look up and realize the game has already been rewritten. And the one holding the pen is no longer them.